Most people investing right now are quietly losing $10,000, not because of the stock market, not because of bad luck, but because of one simple mistake they don't even know they're making. It comes down to the difference between an index fund and an ETF. And no, they are not the same thing, no matter what you've heard. By the end of this video, you'll know exactly which one is costing people that $10,000, which one you should be using, and why the answer is simpler than any finance influencer wants you to believe. Quick disclaimer, I'm not a licensed financial advisor. This isn't personalized advice. Let's break this down simply. Let's start simple. Both index funds and ETFs do the same core job. They bundle together dozens, hundreds, or even thousands of stocks into one single investment. So instead of picking individual companies, you own a slice of all of them at once. An index fund, sometimes called a mutual fund, is bought and sold once a day, after the market closes, at a single price. An ETF, short for exchange-traded fund, does the exact same bundling, but trades throughout the day on an exchange, just like a regular stock, with the price moving in real time. That's the core technical difference. Everything else comes from that one fact. Here's where it gets practical. Many traditional index mutual funds have a minimum investment, often $1,000 to $3,000 to even get started. That can be a real barrier if you're just beginning. ETFs, on the other hand, you can buy for the price of a single share, sometimes under $50, and with fractional shares now common, you can start with literally $1. If you're investing $1,000 like we talked about in last week's video, this is a major factor in which option is realistically available to you. Next, trading flexibility. Because ETFs trade throughout the day like stocks, you can buy or sell anytime the market is open, and you'll see the price move in real time. Index mutual funds only execute once a day, at market close, so you don't know your exact price until after you've already placed the order. For long-term investors, this barely matters. For someone who wants more control, ETFs win here. On fees. Both have gotten incredibly cheap over the last decade. Look for an expense ratio under 0.10%, regardless of which structure you choose. A fund charging 0.03% versus 0.5% might sound small, but over 30 years, that difference can cost you tens of thousands of dollars in lost growth. ETFs are generally more tax efficient than mutual index funds due to how they're structured behind the scenes. This means ETFs typically trigger fewer unexpected taxable events for you as the investor. Here's the honest answer. For most beginners starting today, an ETF tracking the S&P 500 like VOO or SPY is the simpler entry point. Lower minimum, more flexibility, slightly better tax treatment. The fund you pick matters far less than the fact that you're consistently investing in something low cost and diversified. Don't let this decision become a reason to delay starting. Let's make this concrete with two real people. Meet Sarah and Mike. Both are 30 years old. Both invest $200 a month into an S&P 500 fund for 20 years. Same index, same market returns. Sarah uses VOO, a Vanguard ETF with a 0.03% expense ratio. She buys it through Fidelity with no minimum and no trading fees. Mike uses FXAIX, a Fidelity Index mutual fund, also tracking the S&P 500, also with a 0.015% expense ratio. At the end of 20 years, assuming an 8% average annual return, Sarah has approximately $118,000. Mike has approximately $118,200. The difference? About $200, that's it. Over 20 years of investing, the structure ETF versus index fund barely move the needle when both have ultra-low fees and track the same index. The real lesson here isn't ETF versus index fund. It's this: low cost plus consistency wins every single time. Sarah and Mike both beat the person who picked a high-fee, actively managed fund, who ends up with closer to $108,000 after fees. Eat into their returns over 2 decades. That's the $10,000 mistake most people are actually making. So that's the real difference. Same core idea, different structure, and for most beginners, ETFs offer the easier starting point. But as Sarah and Mike showed us, what matters far more than the structure is keeping your fees low and staying consistent. Let me know in the comments which one you currently use.